Good afternoon, ladies and gentlemen, and welcome to the first of two IBOR transition virtual client webinars being hosted by Standard Chartered this month. Today, we're focusing on the transition away from US dollar LIBOR in particular, and how we at Standard Chartered are preparing to support our clients during this transition. Before proceeding, we wish to point out that today's presentation and supporting materials have been prepared by Standard Chartered for the purposes only of this client briefing. As you would appreciate, LIBOR transition is a constantly evolving topic, and some of the information in this client briefing may be subject to change after this date. Presentation and supporting materials are not intended in any manner and should not be interpreted as Standard Chartered providing advice. We recommend that you continue to obtain your independent professional advice in this regard. So before we get into the presentation, I have a couple of housekeeping items. The session is being broadcast live using the Blue Jeans events platform, and we are sharing the slides on screen. All attendees will be placed on mute. If you're having trouble viewing the slides, please expand the screen or move the slider bar, both of which are found at the bottom of your screen. Please note that this is a client-facing session. Throughout the presentation, you may post your questions in the Q&A panel on the right of your screen. Our panelists will pick up your questions and address them at the end. If we do not get to your question, please be assured that we will follow up with you after the presentation. So please post your questions with your full name provided as well. Over the next days, you can expect an email from us with a link to the website where you can access these slides as well as a recording of today's session. To the next slide, please. My name is Carmini Rambazic, and I am the Head of Change Management for the bank's IBOR Transition Program. Joining me on the call today are Gautam Kumardas from Transaction Banking, and we have Tek Pyarpur from our Conduct, Financial Crime and Compliance team. In addition, we do have a number of subject matter experts from across the businesses who've joined us today as panelists and will be ready to take your questions at any time. So we do encourage you to post your questions in the Q&A panel on the right. Next slide, please. So what can you expect to get out of today's briefing session? As the industry prepares to move away from US dollar LIBOR or the London Interbank offered rate, it is important that you prepare for the upcoming cessation of US dollar LIBOR. And we'll speak further on the cessation timeline in a few minutes. We'll also share information on the liquidity of the alternative benchmark to US dollar LIBOR called SOFR, or the Secured Overnight Financing Rate. We'll also cover the bank's RFR capabilities across products and highlight some remediation considerations to be aware of and provide you with an overview of what you can expect from the bank over the coming months. The next slide, please. So on the 5th of March of 2021, the ICE Benchmark Administration, or the IBA, which is the LIBOR administrator, as well as the FCA, or the UK Financial Conduct Authority, both announced the timing for the cessation or the loss of representativeness of all 35 LIBOR settings. This marked the end of what was once deemed the world's most important number, bringing it to a close, the 36-year run that LIBOR's had since its inception. This announcement provided certainty to market participants on the timing of LIBOR cessation, and it has allowed firms to work towards interim milestones to support the transition. Specifically, last year, the IBA ceased the publication of all non-US dollar LIBOR settings on the 31st of December 2021, including the 1-week and 2-month US dollar LIBOR settings, whilst the 6 remaining US dollar LIBOR settings will cease on the 30th of June 2023. Now, specifically on US dollar LIBOR, which is the green box on the top right of your screen, whilst the 6 US dollar LIBOR settings will continue to be published through to June of next year, the bank, in line with expectations set by regulators, has ceased entering into new transactions that reference US dollar LIBOR since 31st of December last year. So other than for very limited circumstances such as risk management of existing positions. So bottom line, no more new US dollar LIBOR contracts are being entered into. There are other LIBOR or IBOR cessation dates on this slide. Following the lead of the FCA, regulators for other jurisdictions have also considered the suitability of other IBOR benchmarks, either reforming them or replacing them, especially if these benchmarks shared some of the systemic failures of the LIBOR benchmarks. This timeline shows these other benchmarks up here, for example, SIBOR, CLIBOR, etc. If you look at the 30th of June 2023 bottom right gray rectangle, it aligns to the US dollar LIBOR cessation and covers benchmarks such as MIFOR, FIREF, SOR, TIBOR FIX. If you have exposures in any of these benchmarks, which use US dollar LIBOR as an input in their calculations, these will also cease at the end of June 2023. So please do speak with your relationship manager or email us centrally if you have any questions on this. The next slide, please. So as a quick reminder, LIBOR is a benchmark rate that is used to calculate interest in different financial contracts. Over time, there has been a decline in the underlying financial transactions of the rate, and this has led to an increased reliance on the judgment from a panel of banks instead of relying on robust market data. And as a result, new transactions in US dollar LIBOR are no longer being offered since the 31st of December of 2021, while there have been a number of alternatives out there, SOFR, or the secured overnight financing rate, is the top contender and is entirely transaction-based, unlike LIBOR. SOFR has been recommended by the Alternative Reference Rates Committee, or the ARC, which is an industry group that has been convened by the US Federal Reserve and the New York Fed. One element that these graphs aim to highlight is how the market has really transitioned from using US dollar LIBOR to SOFR. This has greatly supported the transition efforts. And it does imply that market participants are no longer transacting significantly in new US dollar LIBOR. And so we are seeing fewer LIBOR contracts being executed, meaning there will be fewer contracts to remediate. On the graph on the left, you can see that the liquidity of SOFR in the derivative space has increased significantly, both in terms of volumes and trade count. You can see that the notional that was traded increased quite dramatically quarter on quarter in 2021, with Q4 showing close to $90 trillion of derivatives linked to RFR swaps. In January of 2022, so this year, it's not shown on this graph, but with the cessation of US dollar LIBOR for new transactions, there was a further marked increase in volumes with a $44 trillion uptake in derivatives traded in January alone. So certainly in the derivatives market, we are seeing a steep uptake of SOFR instead of US dollar LIBOR. You can see a similar story in the graph on the right of this slide. Looking at the leveraged loan market, we can see that volumes of newly issued US dollar LIBOR linked loans decreased rapidly as we approach 31st December of 2021. We can see here that new issuances totaling $60 billion were issued in SOFR in January of 2022 alone. So these are very significant increases and really important to facilitate the transition from US dollar LIBOR to SOFR. They should help to alleviate any doubts about market liquidity, and it is encouraging for clients who are ready to commence their transition planning or remediation activities. The next slide, please. So what happens to existing contracts that you may have, which have been priced with US dollar LIBOR and mature after June of 2023? So remember, LIBOR will stop then, or it will lose its representation. So these contracts need to be repriced or converted using an alternative rate, and the earlier we start, the better. There are some fundamental conversion principles that you should be aware of in relation to LIBOR transition. So firstly, existing US dollar LIBOR contracts are unlikely to contain fallback language that is efficient. Fallback language refers to document terms that are intended to provide for a smooth transition to an alternative reference rate in the event LIBOR ceases to exist. Where existing US dollar LIBOR contracts do contain existing fallback provisions, at the time they were included in the documentation, it was unlikely to have envisaged this permanent cessation of the benchmark rate. So as a result, when LIBOR does cease, it could leave the client at risk of having a contract that is no longer operating as intended upon cessation. So clients with contracts containing US dollar LIBOR exposures maturing beyond 2023 or June 2023 need to prioritize the remediation of their contracts to avoid this risk. Any US dollar LIBOR contracts maturing prior to 30th of June 2023 can be allowed to expire or mature. So back to the remediation, how could that work? Clients are able to choose to remediate either through the active conversion of their contracts or through the inclusion of robust fallbacks within their contracts. You should assess which remediation approach is most suitable and then seek independent advice where necessary and speak to your relationship manager. The next slide, please. So the active conversion of US dollar LIBOR contracts to SOFR can be arranged with immediate effect or at a predetermined future date. So through the active conversion, you can control the timing of the transition, have economic certainty for the cost of the remediation, and mitigate the risk of reduced market liquidity in US dollar LIBOR as we are approaching the cessation dates. The inclusion of fallbacks provides a safety net for contracts, but this does not prohibit the active conversion of a client's portfolio. And so clients can agree to the inclusion of fallbacks whilst continuing to discuss the active remediation of their portfolio at the same time. The inclusion of robust fallbacks in contracts allows contracts to reference an alternative rate such as SOFR upon the cessation of US dollar LIBOR, and both the rate and the mechanism of switching can be specified in the contracts. The next slide, please. So, honing in on the remediation of loans, as far as possible, the transition of US dollar LIBOR to SOFR should have no detriment to either contractual party. As such, to ensure a fair contract conversion, a credit adjustment spread or CAS must be applied. This credit adjustment spread is published on Bloomberg and is recommended by the ARC to roughly equate SOFR with LIBOR. As the illustration on the bottom half of the slide shows, the CAS is applied to the SOFR to reflect the fact that LIBOR contains both an embedded term and credit premium, whilst the overnight SOFR rate does not. There are two methods for calculating the CAS. Whilst US dollar LIBOR continues to be published, the forward approach is available, reflecting the forward-looking basis between the US dollar LIBOR and the SOFR swap markets. Alternatively, a historical approach can be used based on a 5-year historic median between LIBOR and SOFR. You can access the CAS rates on the Bloomberg site, and we will share the links with you in this presentation later. You will find them under the resources section. The next slide, please. So we've covered the remediation of existing LIBOR contracts, but for clients who want to enter into new deals with RFR pricing, Standard Chartered has developed a full suite of RFR capabilities, which I'd like to talk to you about now. So starting with derivatives. If you trade other currencies, you will have noticed that the bank has switched from offering Euro, GBP, Japanese yen, and Swiss franc products in LIBOR to their alternative or RFR equivalents. And we started this in 2021 already, which was in line with the previous slides where you would have noticed the increases in RFR liquidity. This was particularly the case for the sterling market, which transitioned away from LIBOR earlier than other currencies. We have a comprehensive product suite across all currencies, including local currencies such as the Singapore dollar and Thai baht. And more importantly, we have very broad product capabilities available out of our main financial hubs globally. So speak to your relationship manager if you need more information on that. These products on this slide with derivatives include swaps and cross-currency swaps, as well as options, caps, floors, and range accruals available in the local currencies and also in SOFR. We've also rolled out these capabilities in other types of transactions, such as repos, structured investments, and structured rate loans. We also see a pickup in interest in the use of term SOFR from our clients. It functions similarly to Liable in that it is forward-looking. It is a forward-looking RFR benchmark and is available in 1 month, 3 month, 6 month, and 12-month tenors. But its use is limited in the derivative space as per the guidance received from regulators. So you should not assume that term SOFR will be available in the same products as US dollar LIBOR. And Gautam will speak a little bit more about this in a short while. To qualify its availability in the derivative space, term SOFR should only be used by end users hedging a cash term SOFR exposure. And this was set out in the ARC recommendations for the use of term SOFR a short while ago. The next slide, please. In the lending space, the bank is able to offer RFR pricing in both bilateral and syndicated loans, with booking locations in 21 different jurisdictions at present. For US dollar LIBOR lending products, the preferred convention is to offer overnight SOFR products. And in addition to the LIBOR alternatives, the bank is also able to offer RFRs in local currencies such as SOR and Thai baht fix. As a reminder, US dollar LIBOR is a forward-looking rate based on panel bank submissions, meaning it contains both credit and term premiums, whereas overnight SOFR is backward-looking based on actual transactions. As SOFR does not contain the credit or term premium, clients can expect lenders to adjust the margin to reflect credit and term premium. In addition, it's worth noting that overnight SOFR, unlike US dollar LIBOR, can't provide cash flow certainty as it is calculated in arrears. I'm now going to pass the presentation on to Gautam Kumadas, who will speak on transaction banking capabilities and walk you through a few scenarios that will help you understand the remediation a little better. Gautam, over to you.
Thank you, Kamini, and good morning and good afternoon, and thank you all for joining us. So the next few slides, we are going to be discussing the RFR capabilities for transaction banking and also go through a few scenarios that we have for both transaction banking and lending products, which could be a part of the same facility. So in this particular slide, what we have is the overall capabilities for transaction banking. What is important to note over here is some of the key differences as well as similarities that are there between the dollar LIBOR rate as well as the term SOFR rate over here. So dollar LIBOR, we are all aware, is a forward-looking benchmark. Similar to that, the term SOFR rate is also a forward-looking benchmark because of the fact that it is derived looking at the CME futures, and there is a fairly robust calculation methodology to provide the forward expectation of the overnight SOFR rate itself. So it is forward-looking in nature, and consequently, if you apply those to transactions, you will have that cash flow certainty, which we expect from or which we are familiar with in the LIBOR world itself. Now, in terms of term structure, also it's fairly similar to what you have experienced thus far in LIBOR. The pivotal tenors of overnight 1 month, 3 months, 6 month, and 12 month are available for LIBOR, obviously, but they are also available for the term SOFR rate. Just a small point to note over here: the industry or the alternative reference rate committee, which is more like the industry regulator for term SOFR, is yet to officially endorse the 12-month tenor point alone. But all the other tenor points, which are 1 month, 3 month, and 6 months, have been officially endorsed by the regulators. Now, Kamini also briefly touched upon this in one of the previous slides. The key difference over here between term SOFR and LIBOR is the fact that LIBOR, whilst it is a forward-looking curve, it is also a credit curve in some way, shape, or form. So it does contain a term element in it, a forward-looking term element in it, as well as a forward-looking credit element into it. Now, all of these are obviously embedded inside the LIBOR rate that gets published. For term SOFR, and this is something common for all the term RFR rates, given the fact that they are derived from a market which is nearly close to a risk-free market, the only component that they have in them as a part of their forward-looking nature is the term premium. So these rates, the term SOFR or the yen TORF or the term SONIA reference rates for that matter, do not contain your credit premiums in there. Consequently, most lenders will look to embed them in margins or provide them via the CAS and or forward-looking basis swaps. So in terms of how what our preferred pricing approach is for typically for transaction banking products, which also includes overdrafts and short-term lending products, we would be looking at using term SOFR for US dollars, term SONIA reference rate for pound sterling, the TORF rate for Japanese yen. And in the case of euros, the existing benchmark Euribor continues. So we continue to use Euribor in our pricing. I'm just going to spend a few more seconds on how the overall pricing construct is going to look at, because this will be the basis of what we would discuss in some of our scenarios that we have. You're quite familiar with the existing pricing construct that you would see typically documented in your facility letters and agreements. They come in two components. One of them is the benchmark, and the other one is the margin. The benchmark in the LIBOR world for dollars is, of course, US dollar LIBOR. And that, when we transition away from LIBOR, will be term SOFR for US dollars. And the margin, as just mentioned before, given the fact that the term SOFR rate only contains an element of term premium, the margin will contain an element of the credit risk premium that is typically incurred. If you could move to the next slide, please. Thank you. So over the next couple of slides, we are going to be looking at some remediation scenarios that we will that you could encounter, given the fact that we are looking to transition away from LIBOR and its ultimate cessation being 30th June 2023, closing in fairly quickly. So in this very first scenario, we are looking at different products that are documented in a single agreement under a single pricing construct. So I have an existing import invoice financing and a short-term loan priced on USD LIBOR. Can I remediate them together? Yes, you absolutely can remediate them together. And in the next slide, we will discuss how this will go about. If you could move. Thank you. So the scenario over here is, of course, the different products documented under a single agreement with the same pricing construct. On the left-hand side of the slide, we have how these were priced in the LIBOR environment, and on the right-hand side, we have them in the post-LIBOR environment. So the pricing as such, as mentioned before, is comprised of two components. Your benchmark rate, which in this particular instance is a 6-month LIBOR rate, and your total margin that is quoted over there. Similarly, for the 6-month term loan, you have the benchmark rate over there, and you also have the margin as quoted in the agreement itself. Now, if you would notice, the only variable component, even in the LIBOR world, is the changing of the LIBOR rates, because it is quite possible that you would have a drawdown request on the IIF initially, and subsequently you could have a scenario where you would require a short-term loan. So we have taken that same construct and how we put prices in the term RFR world. So the familiarity between the pricing constructs is that they are still built of two components. One is the term, the base rate, and the other one is your margin. So the 6-month IIF, if we are to price it in the post-IBOR world, instead of referencing the 6-month LIBOR, it would now reference the 6-month term SOFR rate. To that, we would add the margins that are already documented in the contracts, and the sum total is the all-in price that you would end up paying. Consequently, you have also, or rather subsequently, you have a requirement for a short-term loan. The construct again remains the same for that. The only change over here would be obviously because of the term SOFR rates being a market-determined benchmark. those rates would differ, and we would pick the rate as on the date of the drawdown, but the margin as such would remain as it has been documented inside the contracts. And the sum total of both will be your all-in rate that you would pay for the IIF as well as for the short-term loan. If you could move to the next slide, please. Thank you. Now we have a scenario where we have different products that are documented in the same agreement, but they have different pricing constructs. So I have both a short-dated import loan and dated term loan based on USD LIBOR in the same agreement. What is the preferred remediation approach? The bank's preferred remediation approach is to convert to term SOFR for the short-dated import loans and to overnight SOFR for the long-dated loans. And in the next slide, we will explain to you how both of these will work. So in this particular scenario, we're going to be looking at the post-IBOR world. So in the first case, where we have a 6-month import loan, and please do bear in mind that this is a floating rate sort of a transaction. So that is why we have we'll have multiple resets through the period. But what is important to note is that the total margin that is quoted is as per the agreement, and that remains consistent throughout the pricing. So your only variable component would be converting from would be referencing the 1-month term SOFR rate on the designated date where the fixings or the resets are typically published inside your in your contract itself. Similarly, if we were looking at a 2-year term loan that resets itself on a semi-annual basis, how does that pricing construct work? So over here, unlike the import loan, we have 3 different components actually. We have the compounded SOFR rate, the overnight SOFR rate, which is compounded on a semi-annual basis. We have the credit adjustment spread, and we have the margin that is quoted as per what's documented inside the contract. The sum total of all of those will be the cost that you would need to pay for that particular reset. Now, 6 months down the line, the same calculation will repeat itself, and the rate will get reset, and the existing operational process that you would follow is going to continue. So this process will continue to repeat itself till the 2-year contractual maturity of that particular transaction is reached out. Over here as well, similar to the import loan example, what you will notice is that in the table on the right-hand side, the credit adjustment spread as well as the margins, they remain constant throughout the contractual maturity of that particular drawdown. So your only variable component is the actual SOFR rate in this particular case. If you could move to the next slide, please. Now, here we have a scenario where you have undrawn facilities. So this particular scenario is dealing with undrawn USD LIBOR lending facilities. I have an undrawn USD LIBOR lending facility. Do I need to remediate it? Yes, any facilities that are linked to USD LIBOR will require remediation by 30th June 2023, and we will take you through an example of that one. If you can move to the next slide, please. Thank you. So over here, the scenario that obviously we're looking at is the undrawn USD LIBOR facility. So there are no active exposures as such on that particular facility, but there is obviously potential for drawdown requests to come through in the future. So over here, we have the facilities that are, of course, linked to overnight 1 month, 3 month, 6 month, and 12-month LIBOR tenors, and all of these will obviously require remediation prior to 30th of June 2023. And any new drawdowns would need to be made against the alternative reference rate. So at the bottom of the slide, you see a small timeline that we have provided, where your conversion date is determined or bilaterally agreed between yourselves and the bank to be somewhere in March 2022. So up until that time, the facility would be indicating that pricing is based on USD LIBOR plus margin. Subsequent to that conversion date, that pricing will convert to a compounded SOFR plus the credit adjustment spread plus the margin. because this is predominantly a long-dated lending facility, we would be using the overnight SOFR, which is compounded either on a periodic basis, depending on what frequency has been agreed, the relevant cash for the contractual maturity, as well as the margins that are documented. If you could move to the next slide, please. Thank you. And this is our final scenario that we would be discussing today, where typically you would not just have facilities which are quoted or documented only in one currency. They do have provisions for them to be documented in multiple currencies. So in this particular scenario, we are looking at a multi-currency facility and how we approach it for remediation. Now, given the fact that we are already in the first quarter of 2022, by now, the non-USD currencies, that is Japanese yen, euros, Swiss franc, and pound sterling, would already have been remediated in your contracts. So the only unremediated portion, so to speak, would be the US dollar component of the of your multi-currency facility, and these would definitely need to be, and this would also definitely need to be remediated. So the methodologies obviously can be harmonized across currencies in a single multi-currency facility, which was a lot more relevant for LIBOR because that was a common underlying denominator or a common benchmark. Whereas in the post-IBOR world, each particular benchmark or each particular currency has its own independent benchmark. So from a documentation perspective, or also from a pricing perspective, the facility will need to have associated to it a particular currency and the benchmark very specific to that particular currency. Now, in order to also try and reduce any operational complexities, such as having both forward-looking and backward-looking rates in a single currency, you also could consider documenting them in separate facilities. But that's something that we leave at your discretion, and something that you can also pick up as a point of discussion with your relationship managers. I will now pass this on to my colleague Tiak Piao to take you through the next few slides. Thank you.
Thanks, Gautam. Hi. So the next couple of slides will extend, I think, the discussions that Kamini and Gautam has brought you through regarding LIBOR cessation. Kamini's mentioned about dollar LIBOR cessation, and as well as the new risk rates and the products that are already in the market and the bank offers. And Gautam has taken everybody through the remediation possibilities. So the next two slides actually cover rates that are also affected by dollar LIBOR cessation, and that would be rates that might be used by clients in this part of the world. So I would start with Singapore. In Singapore, the commonly used rate for Sing dollar transactions in derivatives and also loans is the Sing dollar swap offered rate. So that will actually be discontinued after June 2023. That's because SOL has a dollar LIBOR component as in its calculation. Replacing SOL is actually SORA, so that's the new risk-free rate, and clients with SOL-linked exposures will be receiving or will have received various engagement letters from banks, including from Standard Chartered, about remediating their existing SOL exposures to SORA. So related to this is there is also another Sing dollar rate, SIBOR, the Singapore Interbank offered rate. So SIBOR is also progressively going to cease by the end of 2024. And again, the ABS and the steering com governing the Sing dollar SOL SIBOR transition is also working with the banks as well as with clients to transition SIBOR facilities into SORA. So SIBOR is primarily used in loans as well as in a number of retail products. So moving to India, India has a rate called MIFOR, that's the Mumbai Interbank forward offered rate. So again, this rate has a dollar LIBOR component inside. It will be discontinued after 30th of June as well. And for Standard Chartered, with these new transactions in MIFOR, new contracts will be offered on using what we call the modified MIFOR benchmark. existing contracts will be remediated to a daily adjusted MIFOR. So MIFOR is generally used in the derivatives world. So it's, most of the counterparties using MIFOR will be essentially financial institutions. Next slide, please. So the other two rates, which is affected by dollar LIBOR, is actually the Thai baht, a Thai baht rate and a Philippines rate. So the Thai baht rate is known as Thai baht fix. So the Thai baht fix will be discontinued 1st of July, and the replacement rate is known as the Thai overnight repurchase rate, and that is actually already been published and launched by the Bank of Thailand, and the Bank of Thailand has also set up a number of milestones for financial institutions and clients in terms of transitioning away from Thai baht fix to THOR. So that is already ongoing, and again, Thai baht fix is used pretty broadly in derivatives, as well as in a number of lending and also bond products. Last but not least, the Philippines Interbank reference rate, FIREF. Again, cessation will be 30th of June. The Philippines Central Bank, together with the Bankers Association, have been again progressively seizing some of the tenors, as we can see here, and basically what will happen, what's happening now is that in terms of FIREF, we will only be seeing certain tenors now, and the expectation for banks is, as well as clients, is to essentially transition away from FIREF eventually. The local associations and the regulators still working on the alternatives to FIREF. So do keep a watch if you have exposure in FIREF. Again, FIREF is primarily used in financial derivatives contracts. So for clients with such exposures, do keep a watch on the developments, or reach out to us if you have any questions. So these are the four rates which are also affected by LIBOR transition. And if clients have exposures to these rates, right, do make plans, do engage us, do engage other bankers to talk about how you're planning to transition all these rates. With that, I'll hand it back to Kamini.
Thank you, Tek Piao. Just as a reminder to all our attendees today, this session is being recorded, and you will receive an email with the link to the slides and the recording as well. We've had a few questions on that, so I just wanted to mention it here. So thank you to Tek Piao and Gautam for explaining through and walking through their slides. So before we go any further, I wanted to just recap some of the key messages and takeaways from today's presentation. Bottom line, we have stopped issuing new US dollar LIBOR price products since December of 2021, and any new deals will be booked in SOFR or an alternative RFR. SOFR liquidity has increased significantly and is now very strong in both the derivatives and lending markets. And so clients should identify their US dollar LIBOR exposures and prepare to transition their portfolios. Once you identify any US dollar LIBOR contracts, you may want to prioritize the remediation of any contracts that mature beyond the 30th of June, 2023. Clients should weigh up the benefits of active conversion and fallbacks, and seek independent advice where necessary in determining the best approach to their particular portfolio remediation. And finally, the bank is ready to support you in your transition to SOFR, so please reach out to your relationship manager if you would like to discuss remediation of your portfolio. If not, we will be in touch with clients. As Tek Piao mentioned, various client outreach activities have commenced, and so you may have already heard from us on this front. Moving on to the next slide, please. So what can you expect from us? We do acknowledge the importance and the scale of the transition, and we're very much committed to partnering with you and assisting you through it, which is why we're running these sessions every quarter. We have a second one later this week. You will receive communications, as I mentioned, and if you haven't already, you will certainly hear from your relationship manager in the coming months. If you are ready to transition now, we can discuss these remediation options with you and make a start on the transition activities. And equally, if you're not ready to transition, we're happy to provide you with support to help you prepare. so that you can be ready in time and avoid any risks of having US dollar LIBOR referencing contracts beyond the cessation dates that we've mentioned. Moving on to the next slide, we have a number of resources that are on this slide, which you will receive via email. And these you will notice on the right side of this slide, we do have links to the Bloomberg site where the credit adjustment spread, for example, is published. So with that, we have come to the end of our presentation. It gives us some time to address some of the many questions that you have all posted on the Q&A panels. So thank you for doing that. We will start taking some of your questions. We've had, as I mentioned, a few questions on the slide deck and the recording. Yes, you will receive that. Now, our panelists, I've mentioned we've got a number of subject matter experts that have joined us today and been very generous with their time, and some of them have actually started answering questions directly on the panel here. We won't go through all of them because some of them are pretty self-explanatory, but I think some do warrant our panelists speaking to them as well. So I'll start at the bottom of my screen anyway, and there's a question on the advantages and disadvantages of opting for cumulative and non-cumulative rates if they do in fact result in the same interest calculation. We have Arti Bajaj from our lending workstream. And Arti, you have explained that there is a marginal difference between the two calculations and both methods in handling prepayments. Is there anything else you wanted to verbalize in particular with regards to these to the points you've posted here?
Yeah, hi. Thank you, Kamini, and hello, everyone. I think that's essentially the crux of where the difference lies between the two. But other than that, what would be of interest is to see that where you may have a loan with a linked swap, what is the preference on the pricing method that would enable you to have, let's say, a perfect match on the loan and the swap repayments that may be required. Again, this is an independent assessment that should be made based on your portfolio and based on your financial reporting needs. I think that would be the other point to look out for. And if you'd like to know how the calculations differ, then there are multiple RFR calculators that are available at an industry level, and those could be acting as a good reference point to start with.
Thanks, Arti. And that's actually one of the other resources that we will provide in the pack for you. The public slides that Arti has referred to for NCCR versus CCR. Moving on to the next question we did have is, I have an existing US dollar LIBOR contract that contains fallback provision. Should I assume they all require remediation, or do I need to review the terms of each contract? Again, here we do have responses, which hopefully you can see on your screen. The bottom line is we will require remediation to convert to RFR either upon the next interest reset date, this is via the active conversion, or upon LIBOR cessation, which will happen at the end of 30th of June 2023. Both these are through the adoption of a switch rate language or hardwired fallbacks. Further information on this actual, the details of this mechanism, you can reach out to your relationship manager and they can explain how this will work. Another question or further questions that we've received is the CAS application being adopted by all banks? Short answer is yes, it's right across the industry. It was locked in last year, and it is based on the 5-year historical median, which was set by ISDA for the derivatives market. It happens to be that the loan market agreed to adopt the same locked-in CAS, and this is now being used widely across the industry. Our next question is related to overnight SOFR cash flows. Where overnight SOFR are calculated in arrears, are we able to estimate the future coupon payments? These will only be known shortly after your rates are fixed in arrears, so term SOFR might be a better option in this case for in advance settings if that is what you needed to know. Gautam, you did walk through that earlier on in your presentation, so if there's anything else you wanted to add, you're welcome to chime in. Otherwise, I might move on to the next question.
Nothing further to add in, Kamini. Sorry.
Thank you, Gautam. That's okay. So for the new term SOFR loan, a question from Nadia Alani. For the new term SOFR loan, is the CAS used also the same as the publicly agreed conversion spread published by ISDA for the derivatives market? Nadia, you would have seen that the loans market has adopted what the derivatives market has used based on the ISDA recommendation. So the answer to that is plainly yes. There was a question around why the margin has changed. I suspect it was related to some of the scenarios that Gautam was speaking to. Gautam, you've added here that the margin does contain the credit component embedded in it, which is to make up for the premium that Liable has. I don't suppose, I mean, the question doesn't have much more detail in it. I won't talk to it any further. But there was a follow-up question on slide 13. If we could move to slide 13, please, Liesl. The question was, where is the CAS component on slide 13?
Kamini, I can take this
Yes,
this particular question. So in this particular scenario that we were discussing, the CAS component as such is a part of the overall margins itself. That you can notice between the LIBOR world and the RFR worlds, these look different. So this is predominantly to ensure that there is an economic equivalence between the various pricing methods that we have. That is, as we transition from LIBOR to term RFRs, and as we had previously mentioned, LIBOR contains term and credit premium already embedded inside it, whereas the term RFRs do not contain any credit elements embedded in them. So particularly for pricing short-dated facilities, typically around trade finance or short-term loans, the credit element is a little bit more floating because there can be subsequent drawdowns over the life of that facility. So for that reason, the credit component is adjusted already into the margins and left consistent across as it's documented in the facility itself. Thank you.
Thanks, Gautam. While we have you, there is a question that come immediately after that. Why is term SOFR preferred for short-term loans while overnight SOFR is preferred for long-term loans? Perhaps you could just continue with that, please.
Sure. Particularly for, again, trade finance facilities or short-dated product, short-term loans, I guess clients would always be looking for some form of cash flow certainty, and term SOFR offers that sort of certainty because it is typically agreed and fixed at the beginning of the transaction, as opposed to overnight SOFR, which is typically known only a few days before the interest payments are due. So for any short-dated facilities, the preference would be to have to price based on term rates that are forward-looking in nature. Whereas if you have a very long-dated commitment that runs into years, you could look at the overnight SOFR on a compounded basis. And also another reason is that the term rate market actually extends all the way out to 1 year. So you do have various static points in these term curves that are already available that provide you a very forward-looking view of all these rates. So if you do have drawdown requests that span over a period of over that term structure, you can directly apply these term rates instead of looking for an overnight rate that changes on a daily basis. Thank you, Kamini.
Thanks, Gautam. There is a question that is related to the refinancing example, which I think might be on slide 15, please. If you could move to slide 15. The question is the CAS value used in the refinancing term loan pricing example fixed for the life of the trade? Would it make a difference if we were using the forward or historic approaches referenced earlier? Gautam, I'll just keep you on, please.
Sure. So it is actually fixed for the contractual maturity of that particular drawdown. So if you look through the workings that we have put over there, that particular CAS value does not change through the various fixings that go, and the same applies even for the margin. Now, if you are looking to use the historical CAS or even a forward-looking basis swap, that particular number would get locked in at the beginning of the transaction and remain constant through its contractual maturity. So it really doesn't matter whether you, at least from that perspective, whether you're looking at a historical cash or a forward starting basis swap. Thanks, Kamini.
Thanks, Gautam. So we did have a question here around, will the CAS remain published and adjustment to the interest rate after the 30th of June? Tech Piao, I might just bring you in on this, please. Will the CAS remain published? I don't know if you can see that question on your screen.
Yeah, sure, Kamini. Yeah, so as Gautam's mentioned, the CAS is fixed, has been fixed. I think to be clear, this is the CAS. So that has been calculated and fixed by Bloomberg, and will continue to be available to everyone up to the time of LIBOR cessation and possibly after LIBOR cessation. So clients can refer to that publicly.
Yeah, and we will share the Bloomberg link to that as well. And while I have you, Tech Piao, there's a question on SOR. So as SOR is being discontinued, will there be a term SORA linked to term SOFR as a replacement?
Yeah, I think that's a good question. I think recently MAS has, together with SCSDS, has announced, rather has indicated that there may not be a term SORA coming soon. So certainly not within the year. Primary reason to that is because term SORA will need to be calculated from SORA derivatives, and right now the indications are, well, I think SORA is seeing pretty good transaction volumes in the derivatives world. There may not be sufficient liquidity in the shorter end of the curve to allow for the term SORA rate to be constructed. So that's, I think, what we've heard recently. And I think for clients who are obviously having SOR and or SIBOR facilities, certainly something to keep in mind, that term SORA may not come within the next year or so, and then clients have to then decide what they want to do in terms of transitioning to, let's say, SORA in arrears and or other methodology.
Thank you, Tech Piao. So we did have a question, and I know Artie has responded to this, but I'll just verbalize it. Artie, please, if you could jump in. Do you anticipate any costs or fees for active conversion prior to June 2023, the cessation date? The answer is here, if the conversion takes place on the interest reset date and with no change to the existing tenor setting or any terms and conditions in the existing contract, then there should be no costs applicable. However, for any external counsel fees to draft the revised terms, etc., you need to discuss this separately with your external counsel. Artie, is there anything else you wanted to add to that around the costs or fees that might be incurred?
I tried to summarize it as much as possible, Kamini. I think if someone is interested in knowing about this specific portfolio, I'm going to suggest that it may be best to engage your relationship manager and go through the specifics with regards to what facilities you hold with the bank. But at a broad level, what I've summarized there should be a good starting point.
Thanks, Artie. So as Artie said, relationship managers will be equipped to talk to you about this as well. We have got a number of questions, so I might skip to a few if we don't have any answers actually typed in here. Term SOFR is not credit sensitive, nor is locked credit adjustment spread. How are banks then tending to address this? So term SOFR is not credit sensitive, nor is the CAS locked. How are banks then attending this or addressing this? We do have credit sensitive rates that have been published in the US markets, and we as a bank are not planning to offer those just yet. There's no plans in any case for our systems to be amended to offer these credit sensitive rates. I'm not sure, Tech Piao, is there anything else you wanted to mention on this credit sensitivity point?
Yeah, I think only to just reiterate what you've mentioned, which is that we are monitoring developments in credit sensitive rates. So there are quite a few, as I think clients may be aware of. So Maribor is one of them. There is the Bloomberg I think bank yield index, there is also a new index published by market. So there are a number of these indices that are being used, and this is specifically for the US dollar market. So the bank doesn't offer any of this at this point. We are monitoring developments, and if clients do have questions or do have interest, do reach out to your usual contacts, and we can have a further discussion with you on this.
Thank you, Tech Piao. So a number of questions have been posted, and we have got our panelists responding to you as we're going along. So I'll see if there are any that don't actually have answers which we can address here. And alternatively, we'll just pick up on the ones that are most commonly being asked or being liked. There's a question around the financial reporting period. So where our financial reporting period happens in between the interest period, and our auditors may want confirmation from the bank on a partway interest accrual, etc. This is quite a specific question, and really, as RT has written here, your relationship manager will be best placed to explain how this would work. So any sorts of detailed questions that our RMs have been equipped with information to handle this and to respond to you and help walk you through it. We've similarly had questions on explaining exactly how the cumulative compounded RFR rate will work versus the non-cumulative. This is quite specific too, and really we can have our RMs explain this to you on a bilateral basis. We did have a question, pardon me, I'm going through my list of questions here, just popped up quite quickly. There's a question from Rahad Hussain. If I have a loan for which forward options has been used to make the charge fixed, should we change from LIBOR to SOFR? Will the charge on me be the same? Is that correct? And RT has explained it. So the credit adjustment spread, or CAS, is applicable for the conversion. And this, as I had explained in my slides, because it isn't a like-for-like switch, we have to, and LIBOR has the two premium, the term and credit premium in it, the switch has to account for the difference between LIBOR and SOFR. So that adjustment does take place. It's an industry-wide adjustment that takes place. But if you want to know further details on that, you can speak again to your RM to discuss how your particular portfolio will work in terms of any costs or charges or the actual switch itself. We have a few questions on the CAS, whether it has been determined. So is the CAS determined by the historical approach cheaper than the forward approach? This is, as RT has explained here, the markets are actually moving, and so it's best to talk to your RM about it. But the question then, the follow-up question was, is a spread an option for clients to choose now, or do we have to wait until the cessation of LIBOR? And the short answer is you do not need to wait. You can choose that now.
Actually, Kamini,
yes.
I realize I was writing up in a rush. I'd like to expand a bit more on that
Yes,
last
please.
response, if I may. This was something that I think was covered in the previous presentation as well, where you would have the option to adopt this ISDA CAS for it to be applicable upon the next interest reset date or upon LIBOR cessation. The preference is that we do go ahead with the active conversion and we adopt this on the next interest reset date itself, which means that whenever you have that next upcoming interest fixing, the CAS will be applicable there, and RFR pricing would apply for those clients. Now that's, of course, the preferred method, and there is nothing stopping us from applying this ISDA recommended CAS, which is something that the loan markets has agreed to adopt. So yeah, that would just be that little additional context to share on that response.
Thanks, Artie. So we did have a few questions on I guess it's about related to term, SOFR, and the use of CAS. So do we need to use the CAS for new term loans? Tech Piao, can I just pass this on to you?
Yeah, sure. I think there's been a few questions on term SOFR, and I think my colleagues have answered them. I thought we would be useful to give some context. So for new loans that are, or new transactions, right, whether it's in lending or in trade or in derivatives, and if it's referencing term SOFR, so as to the spreads or the margins that are added on to the trade or to the transaction. So again, that would be something that is driven by the market as well as driven by discussions between the banks and the client, right? And if it's a conversion, I would say something that the client is having or you are having, let's say $1 LIBOR transaction, and you're converting to let's say term SOFR, let's say in the loans world. Yes, certainly things like the CAS or the forward-looking market CAS will start to come into play. So there are subtle, I would say, differences in the use of either the ISDA CAS or let's say the forward-looking or the forward market-driven CAS. So clients, I think, will need to I think really look at the type of transactions and understand, I think, the differences, and then I think obviously discuss with the banks and take a decision eventually on, I think, what your sort of preferred choice will be. And maybe Kamini can take that additional question on BISB and
Yes, please.
I think Artie has really, I think, answered it really well. So we have seen, I think, a couple of loan transactions. I mean, Standard Chartered are not part of this, primarily the US markets. So as I mentioned earlier, I think we are continuing to monitoring this and obviously do engage us as if that you have further questions or interest in this. Back to you, Kamini.
Thank you, Teck Yao. So it's just after the hour, so I will need to draw our session to a close here. Thank you very much for joining. We've had some fantastic questions from all of you. I'd also like to thank our panelists for their participation and helping with the responses. If anyone has posted a question anonymously that we've not been able to respond to, then please do email us and we'll be happy to help. As I mentioned, you will receive a link to the recording of today's session as well as a copy of the slides. That now brings us to the end of the presentation. I hope you have a great rest of day and thank you again for joining us.